Welcome to the complimentary Moneyflow week-ending market review on a Friday, January 31st, 2014. As you know, Wealthy Bucket does not provide trading or investing advice. Before trading or investing on your own, it is highly suggested that you consult a financial professional and find out if it's right for you. Investing in stocks, options, futures, and currency carry risks that can result in a financial loss. So, you'd be hard-pressed to find any direction in the market this week. It sputtered, it went sideways, it traded up, it traded down. At the end of it all, it didn't really make too much ground. I ran into an accountant in the men's room of all places today, and he said, "Well, what's the market doing?" And I mentioned to the gentleman, "I don't know. There is no direction, so that's the answer. I don't know what it's doing." And if you look at the graph here, you'll see for every day that there's gains, the next day it wipes out those gains. So for all of you people out there who are swing traders or position traders or whatever you want to call yourselves, the only type of trading that would have been very beneficial for the last week would have been a very short-term trader, meaning you're going to be getting in on the same day, out on the same day. Now, whether it's in 5 minutes or whether it's in 10 minutes or 15 or an hour, that's irrelevant. Point being, when there's no direction in the market, like we just saw this past week, you got to take short clips. Now, if you've been with us for quite some time, you know that a lot of our ideas are not meant for short-term trading. And the reason why we don't use short-term trading, it's not because we don't like it. We simply believe that most people who try short-term and very short-term trading fail because they can't handle their own emotions, and they trade so much that they grind away their profits, and then the commissions eat away at their capital, and on and on and on and on. And it's just not good for everybody. It's not that we don't believe in short-term trading. We just want people to do well. And hyperactive trading or daily trading, so to speak, is not everyone's psychologically built for that. So a lot of our investment ideas found in Moneyflow aren't for those people. Are for those people because this way they can let the markets run. They're not being affected by the day-to-day moves. That being said, the market's got to move in order for these ideas to kick in. So going back to that story, the accountant said, "Well, what's going on?" And I had to let him know that I don't know, because if you look at the market psychology here, the market's not going anywhere, meaning nobody with the money, which means it's got to be a big institutional investor or a bank or a big hedge fund or whatever you want to call them, no one is willing to commit the cash to make the market move yet. Now, they're not willing to make it move down. They're not willing to make it move higher. They're just not willing to commit the cash to move the market. And if they're not willing to commit the cash to move the market, then our investment strategy dictates you got to lay back, because that's the whole point of our that's a big point of our investment strategy, is to let the market pick the direction for you. And if there's no direction, you can't take any action, because unless you have a few $1 billion to move the market, or you have a few $1 million to move a stock, your risk is too high. You got to wait for the market to make its move before you jump in. And that's the conversation that I had in of all places, the men's room. And he laughed. He said, "Well, that sounds logical," and it is. So the point is that if we let our levels decide when we can take these ideas, and then we let the multi-asset investment model, so we're using, and I'll drill down on that momentarily, if we let the market dictate when it's going to make its move, then we can better time our entry, and we can better manage our money and ultimately our risk to find out what the probabilities will be like if we were to take a short or a long position in the market. And if the market's not making a move yet, you can't make that decision, because the probability of success diminishes. So let's take a look at how the markets reacted this week. if you are a premium member and you're watching this, recall what we talked about in our most recent Bucket Weekly on last week. We talked about how for the first time, in a number of weeks or months, the S&P 500 started to attach itself to the US dollar. And we wanted to wait for another week of confirmation before we can pass that judgment. And it happened last week, but this week the S&P started latching itself onto the euro again because of the amount of risk, so to speak, being taken off the table, and the dollar being the world's reserve currency. You see a lot of people jumping into safety and they're moving back to US dollars. So that inverse correlation stayed intact for this week. And you can see that how the euro traded right. It hung around into our immediate resistance here going into the weekend, and then it just collapsed downwards. Now, you could have taken a short trade here. If you're a premium member, yes, you can take these trades if you like. These levels are designed to identify opportunities for you. You don't have to wait for the money flow ideas to come out. The Bucket Weekly itself is packed with investment opportunity because the levels are laid out for you, and because we're correlating on the markets, you have a rhyme or reason as to why you're jumping in long euro or you're short euro or you're jumping in long yen. It all correlates and it all makes sense so that you have a firm grasp on what on earth you're looking at and what your risks are and what you should be looking out for as traps by the market if the trade goes wrong. So going back to our analysis, we talked about how we expected or we anticipated and we needed another week of confirmation that the dollar was moving, or the S&P was moving back into positive correlation with the dollar, and it didn't happen this week. The euro sold off, the equity markets flattened out. There was really no action coming on this week in the equity markets. And the sterling here also traded lower. It's now trading into our immediate support levels, and it's still positively correlated with equity. So we can still rely on that correlation or that probability model. And you can see euro trades down, Swiss franc trades down, and it's all heading towards their immediate levels. So you know, going into the next week, if you're going to trade off of levels, then your lowest dollar risk is always when you take the investment when it comes out of or breaks below these specific levels, because your risk is this range here. Your reward is determined by where you can identify the next level, and we will do that for our premium members. So taking a look now at yen, and if you read the Bucket Monthly that we sent out yesterday or this morning, and we were relying heavily this past month in the yen for direction, and you can see the yen kept traveling up. It broke through, and we expected, based on last week's forecast, we expected yen to come up and retest these levels. It has not. It's come close. However, we're going to maintain that going into the new week, and we'll talk about more of that in this Sunday's Bucket Weekly. And you can be certain that if yen continues higher, you're going to get a further pullback in equity markets. But as you can see, the yen is nearing its immediate resistance levels. And where is the S&P 500? Well, the S&P 500 is trading in its intermediate levels here. It's hanging around. So something has to happen when a consolidation starts to build. Something big will happen. And no one knows for sure if it's going to go up. No one knows for sure if it's going to go down. However, if you're using our strategy and our investment model like you're supposed to, then you'll know if yen moves up higher, then the equity markets will break down. And if you can see dollar move higher, then you know that the equity markets, based on the current correlation, will break down. And we'll talk more about that. We'll drill down on that in our upcoming Bucket Weekly newsletter on Sunday. And we talked about how Dow, we talked about it in our video on Wednesday, we talked about it on Sunday, that Dow If it doesn't hold, we expect it to trade down to these levels, and it has. And the Dow has been the weakest performer of the four majors. So if you're looking for a buy, the markets are shaping up right now to be at its lowest risk point in terms of buying because it is near the levels. So you get a turnaround in yen, you get a little further drop or a pop up in the S&P, then you can start to see things turn around. Now, you can't automatically assume that the market's going to rally right back to its high and beyond. You got to measure the markets on a level-to-level basis, and we will do that for you in our upcoming Bucket Weekly newsletter. And as you can see, the NASDAQ dropped into its intermediate support, pivoted back out, and tested previous levels, and here we are hanging in the middle. So the analysis is very, very accurate in terms of the market timing. So, and being very accurate, we took very, very few trades. We actually only got into one trade this week, and I'll talk about that momentarily, but I'd like to show you now the different sectors via ETF, and when I was referring to it, the taking a long trade now because the market is going up. So if you take a bullish trade, the markets are at its lowest risk point for these current levels. And if you look at the industrial sector, it's traded right into our levels, and it's sitting there nice and pretty. We just need some indication from the currency markets that risk is being taken by investors. The financials has traded slightly through its level. So based on this, we like the industrials. If you look at the materials traded slightly through our levels as well. If the market rallies around or pivots around right now, we're still looking at industrials as an attractive sector. Transportation is behaving very much like the S&P. It did trade through our levels. The levels are a little bit lean here, however. We are liking the way this is shaping up if the market pivots around. That's the kicker right now, and that's why we're going to go run through the entire investment model for our premium members this Sunday to give a better insight or closer insight as to what to look for in the coming week. And the retail ETF was one of the ones we were looking for because in terms of a bullish idea, because it would be the first one to hit its longer term support levels. And should the market rally away, this sector has been beat down. We're expecting it to do some great things. However, we want confirmation from the market. This is where our analysis was inaccurate this week. Last week, when the market sold off, money did not go back into yield. The utility sector still sold off last week. This past week, while the markets were selling off, now you can see investors jumping in and looking for some yield. So we're gonna use this as a possible indicator going into the new week as well. And let's talk about technology. You can see technology has pivoted right into our levels here. That's why it's so key to understand what these levels are so you can really time the markets and get a precise entry point. If you're looking at consumer discretionary, it's traded below its intermediate levels, and it's heading towards long-term support, just like the retail sector is. And the energy sector traded right down into long-term support as well. And when we talk about long-term support, we're talking about long-term on the time frame we are looking at. Okay, we're looking at a 52-week. It's a 1-year time frame. So this support level we consider as long-term for this specific time frame, and it's traded right in. So there's a lot of opportunities shaping up coming into the new week if we get the break that we want. If somebody out there commits the cash to boost the market up or decides to start taking more profits, we'll look for some shorts. But however, we're going to provide those levels, and we're going to time it up real nice for our premium members going into the new week. One of the trades that we did get into, or one of the ideas we did get into this week, or the only idea we got into this week, was the Qs. We expected the Qs to rally away a little bit harder and faster. It just did not. On Wednesday, It rallied in to our level here, and then on Thursday it gapped up and we got filled on that, and it's now trading a little bit lower than our entry. Well, it's a little bit higher than our entry price, so we're not making huge bank on this by any means. However, we're grinding out some time here, and that is the only trade that we could get into because it actually met our criteria. And this is a very difficult market to trade for most people because of the sideways action. So if you're not available to trade for 10-15 minutes at a time, we highly suggest that you just don't trade until the market makes a direction, because this is your money. The market will never apologize for taking your money. It's got no feelings whatsoever. We assume that you've worked hard for your money, so respect it. Get your education. Understand why the market moves. Understand what moves the markets. This is why we use the Wealthy Bucket multi-asset investment model to correlate to all the asset classes and to create a high probable investment opportunity. It is your money. Respect it. You worked hard for it, so don't just give it away to some stranger in the market. We hope you had a great week. We hope you enjoy your weekend, and we thank you for stopping by the Wealthy Bucket.